For decades, investors have relied on a simple formula: stocks for growth, bonds for safety. When one zigged, the other zagged. But what happens when they start moving in the same direction? Or when inflation, debt, and volatility make the old rules stop working? Hi, I'm Ben Fawcett, portfolio manager at CG Wealth Management. And in this episode of Connecting the Dots, we'll look at why the traditional balanced portfolio is showing its limits and how investors can strengthen it using new tools and smarter sources of diversification. For years, the idea was simple: own equities to grow your wealth and bonds to steady the ride. It worked until it didn't. Over the past decade, bond returns have been disappointing. And in 2022, when both stocks and bonds dropped together, many investors began to wonder, what still works? It wasn't that bonds were broken, just the math. Yields sat near zero for years, which meant future returns were capped. Then inflation spiked and central banks slammed on the brakes. Bond markets fell hard, right alongside equities. Today, yields finally make sense again. Bonds are paying meaningful income and still provide value stability when growth slows. But in a world of higher inflation, they may now move in tandem with stocks more often. And in record government debt issuance around the world, including here in Canada, and the long-term outlook for bond prices gets trickier. More supply means more pressure on yields, and that can erode returns over time. So what does balance look like now? It's not about abandoning bonds, it's about modernizing the mix. Keep equities for growth, keep bonds for stability and income, but add a third sleeve: assets that behave differently. That's where liquid alternatives come in. They use long-short strategies, derivatives, or managed risk tools, but inside mutual funds or ETFs that trade daily. They're designed to deliver returns that don't rely on markets going up and to help smooth volatility when stocks and bonds struggle. By using both sides of the market, these strategies can turn volatility into opportunity. They can smooth the path of returns, but they also require skill, discipline, and clear expectations around how they fit in a portfolio. And they're not alone. Gold, commodities, infrastructure, even Bitcoin can each provide offsets when inflation, growth, or sentiment take unexpected turns. Some hedge inflation, some benefit from physical scarcity, others tap into digital adoption or infrastructure demand. Together, they help create more balance in an uncertain world. Investing has always been about balance, finding the right mix of growth, income, and stability so that investors can stay fully invested, because that's how they capture the long-term benefits of compounding, consistency, and time in the market. And today, with better tools and broader options, that balance is easier to build, allowing investors to better achieve their long-term goals with confidence.